Test, test. We got big news in the financial system. The Federal Reserve looks like they are going to cut interest rates beginning the next easing cycle. In today's video, I'm going to explain what's happening with the Fed. We're going to look at the yield curve inversion that has reversed and what that means for stocks, what that means for your retirement accounts, and so much more. You came here for the truth. So let me unveil that for you. In today's video, we're going to look at all these things. I'm going to break it down really, really easy. Okay, so stick with me. In this article right here, we're talking about the so-called jumbo Fed cuts. Now, there's some that have started to expect maybe the Federal Reserve is not going to cut by 0.25%. Oh no, maybe they'll do a 50 basis points, 75 basis points. That's what they're expecting. Now, this is all based on interest rate swaps. You'll hear about futures. These things are usually very good at being able to find the direction of interest rates, being able to see where they're cutting. Now, what happens here is that the bond market is moving based on the direction that they anticipate things to go. The bond market tells a very big story. And you've heard of the yield curve inversion. Now, this is an example of the yield curve inversion, and now it has uninverted. There's different ways that people refer to it, the steepening of the yield curve. What is that? Okay. So when we, the simplest way to explain it, as I always do, is that if you're going to buy a bond and it's going to be a super long one, let's say 30 years, well, you would think that a 30-year bond would give you a better return than, let's say, 1 year, right? You're taking much more risk. You've got to hold it for 30 years, so you'd expect a better return. However, what happens is during these periods of time, they flip the other way, and you actually get a better return on the shorter dated debt. And so that happens. It's a yield curve inversion. It's a sign, a signal of a big problem. And what you'll notice here in this chart where the red shaded areas are, those are recessions. And so when the yield curve does invert, it barely did, by the way, during this period leading into 2020. And it would have been much worse had they not had to shut everything down and then print a whole bunch of money. But anyway, looking at this every time, we see the same pattern. When the yield curve inverts and then starts coming up the other direction, that's when a recession hits. So this is very key to watch. What is the disinversion telling us? A restoration of the normal upward slope of the yield curve, or disinversion, typically happens when the Fed starts to lower interest rates or markets start pricing in looming cuts. I have heard from people in the industry that manage other people's money that say you don't have to look at what the Federal Reserve's doing. They don't affect that. But what do they look at? Oh, let's look at, if we want mortgage rates, yeah, let's look at the 10-year, because the 10-year is correlated highly, the Fed funds rate or the central banks. No, don't look at them. But they are the center. They are the nucleus of all of it. Yes, markets can play there. And of course, the Federal Reserve is just doing one of those many different types of rates that you'll see out there. A commercial bank is the one that actually sets the mortgage rate that you get. But obviously, it depends on what the central bankers are doing that affects their rates. I can't believe that people that manage money don't even realize this, or at least they won't acknowledge it. Since the central bank tends to ease policy when the economy hits a snag, some say that disinversions often signal that a recession is imminent. That's right. And that's what we could be facing. Now, this is, if you stretch it out long, going back 1954 up until today, and you see, it might be a little bit difficult to see on the screen, but you're seeing over and over and over again, almost perfectly. It depends on which you're using. This is a 2-year and a 10-year. Okay. You can do there's 2-year, there's 30-year, there's 3-month, 10-year. There's all these different ratios. Everyone thinks theirs is the best one. All you need to know is that when this process occurs, it usually ends up, the vast majority of cases, ends up in a recession. What happens in a recession is that we get difficult times, layoffs, and so on. But we also get the interest rates coming down and potentially a lot of money printing. Sector and factor performance when the yield curve bull steepens. So I told you at the beginning, and here we are. How does this affect stocks? You could see it for yourself. Where are you invested right now? Do you have a retirement account? What's happening? This is important for you. Healthcare usually does well. All right? You could see that. At the bottom of the list, real estate, utilities, communication services, materials. So just trying to show you what could happen based on what we have seen before. That's all. Okay. So I'm going to move on if you want to take a screenshot of that, or all links are in the description at the bottom where this says sources. S&P performance around 15 historical yield curve uninversions. And you'll look through the list. It is varied, like how it responds, but I think what's important to note is that why we're going into the process in the first place. This has, I was explaining to the Finance Friday crew, it's not because a line goes below another line that means that it's going to, the end result here is, oh, okay, we're in a recession, line below line. No. That's just a signal. That's just one little piece of the puzzle. But what it does is it gives us an indication what is going on right now. We got a problem. Equity struggle after uninversion if the economy enters a recession. So there's all these factors, and you'll hear and you'll see all the YouTube titles and all that nonsense. You gotta know the details. It's like, if this, then that, right? It's programming language. And so you'll see that typically time and time again. Why are we going into this in the first place? Right now, what they're telling us is that the economy is relatively sound. We got some weakness here. We got some weakness. Oh, no, but don't worry. We're going to fix it all up. The economy won't go into a recession. We're just trying to ease the burden because we had high inflation. We're trying to cool that down. That, if they're going to cut interest rates right here, supposedly the no landing scenario, this then would be one of those times. Oh, the yield curve inverts, disinverts, or uninverts, whatever they want to use. And then we don't enter a recession. I don't know. Are we already in a recession? Look, let me tell you what's happening for real, like the real deal. Inflation stings most if you earn less than $300,000. Yes, I said that right. It will hurt you if you're making $300,000 or less, all right? More Americans than ever expect their finances to worsen as inflation hits a 40-year high. Do you really need that extra car? What if I scroll down right over here? What does it say? Time for the bus? You will own nothing and be happy. Now, I don't think you need to have that second car or need to drive a car or need to own a house or any of these things. We need food, shelter. We need, the basic elements. Okay? But if somebody wants to own a car, a home, anything, have a garden, whatever it is, they should be able to. It should be relatively affordable. Now, if somebody wants to buy a super yacht, well, that then shouldn't be available for everybody. You got to make a certain amount of money because these monstrosities require a lot of effort. But a home, the average home, an average salary, there should be some semblance of reality in there. Maybe not your favorite home. Maybe it's like 100 years old. Maybe it needs some serious renovations, but you got out of school, you're making money, you're having an income, you save up for a little bit, you buy a home. Today, you can't even do that. Unless you're getting hundreds of thousands of dollars from your parents, basically, you're coming out of school, you're not paying anything. You're not buying anything. You can't afford it. You see, that's why things are screwed up today. And so the next thing is that we got to look long term. Like, where does this lead us? And I'm telling you right now, there are serious problems. This comes directly from SSA.gov. Okay. What do we have? Unfunded liabilities, or what they call unfunded obligation through the infinite horizon. Beautiful way to say that, but we're talking about the unfunded liabilities. And they put it here. You can read it in the chart. You can scroll down. There's more in there. Link in the description. 63 trillion. I have to say the trillion because some people will say it only said $62. No, my friends. Okay, it's trillions. $63 trillion unfunded liabilities directly from the source itself. Okay, I only show sources of my information, which you generally do not get elsewhere. We are talking about an attempt to basically suggest that we can't afford this. There's no way we can afford it. Never going to happen. But we're going to do something different this time. We're going to tax that. We're going to, they have like all these nonsense ideas that have never worked before. And what occurs? Time and time and time again, the people get screwed. So you've got to take action today because this long-term horizon, you got $63 trillion on your back just in this one thing. There's a lot more depending on what you include. Inflation is up for everybody. They're saying, look, you got to make $300,000. Not for everybody. Depends on what you're spending, depending on what they're including on that in that. But just know what they are saying is like when we're coming from the academics, when we're looking at the politicians, when we're talking about the central bankers, it doesn't matter. They don't have your best interest in mind. You have your best interest in mind, or at least I hope you do. And if you're watching this video, at least up until this point, I know you do. So you got to take action today. I talk about these all the time. 2 things that you can look at is Compass. It's on my website. It's free. Compass is your financial education. You can't get elsewhere for this free. It doesn't give you an email address. You don't got to give $1. You don't got to give anything. You just go to themoneygps.com/compass. You get that. That's your base. Now that starts to get the things in motion where you're going to ask the right questions. Compass is something that everybody needs to watch. And guess what? It's only about 20 minutes worth of content. themoneygps.com/compass. If you're one of those people who's an action taker, you want to actually get into the depths of everything, I have the live sessions. The live sessions, which we've been doing for about a year now, over a year, is something that with people want the mass, like in-depth stuff, this is where it goes. If you're unavailable for the lives, you still get the recordings. I would hope that you join for the lives, but we have some people with like time zone differences. They just can't make it, and that's okay. They can watch the recordings, and they do watch the recordings, but live is definitely optimal. So I would love to see you as part of the groups, whether we're on the Friday session or the Sunday session. Just hit that link at the top of the description, and you're going to get more information. I got a little video and a bunch of descriptions on there for you, and sign up and all that. So check it out. I want to see you there. Take care.